It's 2030. You're sitting on a private beach, sipping a drink, and checking your investment portfolio on your phone. The numbers keep climbing. You're not stressed about money. You're not worried about the future. You're living life on your terms. Sounds like a dream, right? But here's the reality. If you don't take control of your finances today, you could be stuck in the same place 5 years from now. Watching others live the life you want. Scary, isn't it? The good news? You don't need to be a financial expert or have millions in the bank to start building wealth. All you need is a plan. And by the end of this video, you'll have everything you need to create a diversified investment portfolio that sets you up for success in 2025 and beyond. So, whether you're a complete beginner or someone who's dabbled in investing, stick around. This is your roadmap to financial freedom. Let's dive in. Number 1. Asset allocation, the foundation of wealth. Let's start with the foundation of any successful investment portfolio. Asset allocation. Think of it like building a house. You wouldn't start with the roof, right? You need a solid foundation. Asset allocation is that foundation. It's about spreading your money across different types of investments: stocks, bonds, real estate, and even alternative assets like crypto or commodities. Why? Because when one investment zigs, another might zag. This balance helps protect your money and keeps you from losing sleep when the market takes a dip. Now, here's the million-dollar question. How do you decide what percentage to put where? Well, it depends on 3 key factors: your age, your goals, and your risk tolerance. If you're in your 20s, you might lean more heavily into stocks because you have time to recover from market drops. But if you're closer to 30 and thinking about buying a home or starting a family, you might want to add more bonds for stability. Wait, bonds? Aren't those for, like, grandparents? Not anymore. Bonds can be your best friend when the stock market throws a tantrum. Trust me, you'll thank me later. Here's a simple rule of thumb. Subtract your age from 1 in 10. That's the percentage of your portfolio you might want to allocate to stocks. The rest can go into bonds and other assets. For example, if you're 25, you might put 85% in stocks and 15% in bonds. But remember, this is just a starting point. Your ideal allocation depends on your personal goals and how much risk you're comfortable taking. Now, here's the thing. Asset allocation isn't a set-it-and-forget-it strategy. If you don't keep an eye on it, your portfolio could drift off course. And that's where risk management comes in. Let's talk about that next. Number 2, risk management, protecting your wealth. Let's get real for a second. The market is unpredictable. One day, you're up 10%. The next, you're down 15%. And if you're not prepared, that roller coaster can wipe out your hard-earned money faster than you can say diversification. That's why risk management is non-negotiable. It's like wearing a seatbelt while driving. You hope you never need it, but when things go south, you'll be glad it's there. So, how do you manage risk? Start by understanding your risk tolerance. Ask yourself, how much can I afford to lose without panicking? If the thought of losing 20% of your portfolio keeps you up at night, you might need to dial back on risky investments. Next, diversify within each asset class. For example, don't just buy tech stocks. Spread your investments across industries like healthcare, energy, and consumer goods. And don't forget international markets. The US is great, but there's a whole world of opportunity out there. Think of it like dating. Don't put all your eggs in one basket. Unless that basket is named Tesla, then maybe we can talk. Another key strategy is dollar cost averaging. Instead of trying to time the market, which even the pros struggle with, invest a fixed amount regularly. This way, you buy more shares when prices are low and fewer when prices are high. Over time, this smooths out your investment costs and reduces risk. Now, here's where most people mess up. They set up their portfolio, manage their risk, and then do nothing. Big mistake, because over time, your portfolio can become unbalanced. And that brings us to our final, crucial step, rebalancing. Number 3, rebalancing. Keeping your portfolio on track. Rebalancing is like giving your portfolio a tune-up. Over time, some investments will grow faster than others, throwing off your carefully planned asset allocation. For example, if your stocks have a killer year, they might make up a bigger percentage of your portfolio than you intended. That means more risk than you bargained for. So, how do you fix it? You rebalance. That means selling some of the investments that have grown too much and buying more of the ones that have lagged. It's like trimming the hedges in your financial garden to keep everything neat and tidy. A good rule of thumb is to rebalance once or twice a year. But don't overdo it. Too much tinkering can lead to higher fees and taxes. Think of it like a haircut. You don't want to go full-on buzz cut every month, but you also don't want to let it grow into a wild, unmanageable mess. Balance is key. Here's a pro tip. Set calendar reminders to review your portfolio every 6 months. And if you're not sure where to start, consider using a robo-advisor. These automated platforms can handle rebalancing for you, so you can focus on living your best life. Now, before you go, let's talk about one last thing. How to actually start building your portfolio. Because knowledge is power, but action is everything. Your wealth journey starts now. Here's the truth. Building a diversified investment portfolio isn't just about money. It's about freedom. It's about creating a life where you call the shots. And the best part? You don't need to be a millionaire to start. You just need to start. So here's your action plan. 1. Open a brokerage account if you don't already have one. 2. Decide on your asset allocation based on your goals and risk tolerance. 3. Start investing regularly, even if it's just $50 a month. 4. Set a reminder to rebalance your portfolio every 6 months. Remember, time is your greatest asset. The sooner you start, the sooner you'll see your wealth grow. Don't wait for the perfect moment. It doesn't exist. The perfect moment is now. Thanks for watching. If you found this video helpful, hit that like button, subscribe, and share it with someone who's ready to take control of their financial future. Because wealth isn't just about money, it's about living the life you deserve. See you in the next video.